Hello everyone, in this video, we will learn about rights issues, what is rights issue, why rights issues are offered, and how rights issues work. Let us first understand the rights issue. Cash-strapped companies can turn to rights issues to raise money when they really need it. In these rights offerings, companies grant shareholders the right, but not the obligation, to buy new shares at a discount to the current trading price. What is rights issues? A rights issue is an invitation to existing shareholders to purchase additional new shares in the company. This type of issue gives existing shareholders securities called rights. With the rights, the shareholder can purchase new shares at a discount to the market price on a stated future date. The company is giving shareholders a chance to increase their exposure to the stock at a discount. Shareholders may trade the rights on the market in the same way that they would trade ordinary shares. Why does a company issue a rights offering? Companies most commonly issue a rights offering to raise additional capital. A company may need extra capital to meet its current financial obligations. Troubled companies typically use rights issues to pay down debt, especially when they are unable to borrow more money. However, not all companies that pursue rights offerings are in financial trouble. Even companies with clean balance sheets may use rights issues. These issues might be a way to raise extra capital to fund expenditures designed to expand the company's business, such as acquisitions or opening new facilities for manufacturing or sales. So, how do rights issues work? Let's say we own 1,000 shares in Company X, each of which is worth Rs. 5.50. The company is in financial trouble and needs to raise cash to cover its debt obligations. The Company X, therefore, announces a rights offering through which it plans to raise 30 million, by issuing 10 million shares to existing investors at a price of Rs 3 each. But this issue is a 3-for-10 rights issue. In other words, for every 10 shares we hold, Company X is offering us another 3 at a deeply discounted price. This price is 45% less than the Rs 5.50 price at which Company X trades. As a shareholder, we have 3 options with a rights issue. We can 1. Subscribe to the rights issue in full, 2. Ignore our rights, or 3. Sell the rights to someone else. Let us explore each option and the possible outcomes. To take advantage of the rights issue in full, we would need to spend Rs 3 for every Company X share that we are entitled to purchase under the issue. As we hold 1,000 shares, we can buy up to 300 new shares, 3 shares for every 10 we already own, at the discounted price of Rs 3, for a total price of Rs 900. However, while the discount on the newly issued shares is 45%, the market price of Company X shares will not be Rs 5.5 after the rights issue is complete. The value of each share will be diluted as a result of the increased number of shares issued. To see if the rights issue does, we need to estimate how much Company X share price will be diluted. In estimating this dilution, remember that we can never know for certain the future value of our expanded shareholding since it can be affected by business and market factors. But the theoretical share price that will result after the rights issue is complete, which is the X rights share price, is possible to calculate. This price is found by dividing the total price we have paid for all your Company X shares by the total number of shares we own. Let us show it in the Excel sheet. We already have 1,000 existing shares at Rs 5.5. The value will be Rs 5,500, and we purchase 300 new shares at a discounted price of Rs 3, which is Rs 100. The total value of the shares will be Rs 6,400. Now we will calculate the X right value per share by dividing the total value of shares by the total number of shares, which is Rs 4.92. So, in theory, as a result of the introduction of new shares at a deeply discounted price, the value of each of our existing shares will decline from Rs 5.50 to Rs 4.92. The second option is to ignore the rights issue. We may not have the Rs 900 to purchase the additional 300 shares at Rs 3 each, so we can always let our rights expire. But this is not normally recommended. If we choose to do nothing, our shareholding will be diluted thanks to the extra shares issued by the company. and the third option is to sell our rights to other investors. In some cases, rights are not transferable. These are known as non-renounceable rights. But in most cases, our rights allow us to decide whether we want to take up the option to buy the shares or sell our rights to other investors or the underwriter. Rights that can be traded are called renounceable rights. After they have been traded, the rights are known as nil-paid rights. Conclusion: investors may be tempted by the prospect of buying discounted shares with a rights issue. But it is not always a certainty that we are getting a bargain. In addition to knowing the rights share price, we need to know the purpose of the additional funding before accepting or rejecting a rights issue. A rights issue can offer a quick fix for a troubled balance sheet, but that does not mean that management will address the underlying problems that weakened the balance sheet in the first place.
You can contact us from the details mentioned on the screen via missed call, WhatsApp, or email. Thank you for listening the video to the end. Please do like, share, and subscribe the video for the latest updates in the market.